following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Nick in Tampa. Hey, Nick, what's going on?
Tom O'Brien, it is an absolute pleasure.
Thanks so much, man. We appreciate you calling.
No problem. Dude, I've been listening to your show for about 2 years now, and it has just been wonderful. I listen to you, Basil, Andy. You guys do an amazing job.
Well, thank you so much. We appreciate you growling and prowling out here with us.
Now, Tom O'Brien.
Hi, folks. Basil Chapman sitting in for Tom O'Brien. Tom's away, and it's my pleasure to be here. Usually I have the 11 o'clock till noon show Monday through Friday on market days. It's called the Tiger Technicians Hour, and it's my pleasure to be sitting in for Tom. And this is one fascinating market. In fact, when I said to my subscribers to my opening call this morning, it has been just a continuous roller coaster within a trading band, and that trading band should be coming to some kind of a conclusion very soon. But as long as it's stuck there, and I'm just showing the E-minis right now, this is the daily chart. You'll see this is, when you look at my work when I do my show, I show the left side here is the daily chart. This is the E-mini up $1.25 at 2,092.25. This is the middle one, which is the weekly chart. And here on the right, at this particular moment, I've got the 120-minute chart. I want you to show some of the patterns that we look at. The monthly chart, because it's the future, I don't have all that much information on. We'll do that a little later when we look at the longer term monthly charts. So let's just run the numbers now so that you know exactly what we're looking at. We're looking at a Dow that's down 77, and it was up earlier. Now it's down 77 at 17,958. The S&P is only down $1.48, so the Dow's down 0.42%. The S&P is only down 0.07%. At 2,098, down $1.50. The comp index is up 0.50%, up 25 at 5,019. Very interesting. The VIX index is mixed here. It's down 13 cents at 1317, and we will talk a little bit more about the volatility index in a moment. Let's just go on, because I want to also give you that gold is, at this particular time, the GLD is up 64 cents at 115.36. The gold contract itself is up 8.10 at 1201.80, and silver is up 0.06 at 15.95. Now, what's really interesting is that the dollar is up a little bit. It's at 98 on the index. The bonds are down 14.30 seconds at 163 and 11.30 seconds. This is going to be very interesting because you've got high-grade copper. It's down $1.30 at 56.60. Now, what I've been talking about for a very long time, if you don't know my work, my service is called The Opening Call. That's my daily newsletter, very comprehensive look at the markets. Let me just grab something over here. For instance, today, I always show the it's called the Overview section, and it's called Overview and Market Today. And this one usually comes out very shortly after my daily chart on the Dow comes out, my analysis of the Dow. Let me just go to them one at a time. This is the daily Dow that I gave today, 421.15, closed yesterday at 18,034. Excellent reflex rally Monday. That makes the 9-period exponential moving average, the maroon line. That's that maroon line, very important. That fast green. We're looking at 17,980. to 17,950 as the key support. What happened? Went up, and then it plunged. Really, it plunged from the upside. 18,109. Hit that down. You see that dashed line? I'm going to be doing a webinar, 2 webinars on Tuesday. This coming Tuesday, April the 20th. Is that the 25th? A week from today. Now, it can't be the 25th. Today is the 21st. So it's April the 28th. And then again, Tuesday, May the 5th. And within that, I'm going to be discussing all these Chapman wave techniques, how you can use the simplicity of counting each successively higher peak to get you to a D or an E, It's where you've got to be very careful. The simplicity of it also extends to where we're looking at the price performance and adjusting trend lines or the cup formation or the arch formation according to what the chart pattern itself is creating. And in fact, what we're talking about here, I was saying that there were two fighting patterns. There's the larger cup formation, and then there's the little mini arches that are formed. And you made a doji candle, which means that you've got to really close above that doji candle to show some very good support. Then there's a technique that I'll be discussing a week from Tuesday night. These are 45-minute workshops, back-to-back weeks. I want to be able to follow through on a couple of things. One is for my subscribers to my opening call, and this is open just to subscribers, but if you go to the front page, you'll see how you can subscribe for a free period, and you'll be able to get my newsletter every single day, as I say, comprehensive look at the markets with this overview section on the Dow, and then the overview section of the market itself, all the different sectors. Look at this. The Dow went under that 9-period exponential moving average, failed at the dashed trend line resistance, still within the cup formation, mixed market, and that's exactly what we're seeing. You've got the Dow down 75, the S&P down $1.33, and the Qs are up. So let me just, and I talk about the MACD and the slow stochastic. I'll be going through all of that. And let's just move on. I wanted to show you within the context of, right, there. So this is what I show. There are 5 little groups here. This is the 120-minute chart, Dow. This is the 120-minute chart of the VIX. This is Richard Arm's Trend Index. This is the Dow Daily with a notation of and trend lines. And this is the S&P Daily, which has already made a peak D. What do I mean by a peak D? There's a simplicity to this particular technique. You look for the lowest low bar, and you merely count each successively higher peak until you get to the 4th highest peak, the peak D. That's where many other things can happen. Let me move this away, and I can go through these charts and explain exactly what we're looking at. When you're looking at the E-mini, this is the S&P E-mini, you will see that it went to a peak D, the 4th highest peak, at 2109.75 late February, and then it declined sharply down to the 2033.25 level, ran up to a peak C, which kind of failed, pulled back, and then it went again, peak A, B, C, D. Once again, D's created a problem here because 2105.50 was the high of the, I think it was the, what was it, the 15th or 16th, pulls back, and on the 15th, pulls back, and today tried to retest it. It went to 2105.25, missed by 25 cents. Now, the miss is really a very important factor in the Chapman wave. Why? There's a particular technique that I developed over the years that said, if you go to a high, and then either a D, a peak D, or whatever it is at the high, after D, E, or F, you can go to 2 or even 3 successively slightly lower peaks. So you go to a peak here at 2109.75, and then there's one that's underneath that at 2107, and that's the week of the 27th of March. And look, yesterday and today, we couldn't break it either. Even though the techniques say that the stochastic was rallying, but it's still under 80%, and the MACD was trying to cross. So these are the techniques I'll be discussing in the webinar a week from tonight. And this is the 120-minute chart. What did I just say? If you go to a peak D, you got to be careful. Peak D, 2105.25, and the 120-minute E-mini, plop, comes down. So it's a very potent factor in my work, that 4th highest peak. Now let's continue. And we're looking at, it's just right there. So I'm going to explain to you as we're moving along, because we've still got, what, about 40 minutes or so before the close. So the Dow has gone to only a peak C, but it's underneath a previous peak of importance. That was a peak E at 18,288. Now, I gave a webinar on April the 19th of this year, and it was called the match with 1929. What is coinciding? What is different at this particular time with the socioeconomic, political, and technical aspects of the charts in the period of the late 1920s? It is unbelievable. I happened to be in Brooklyn this past weekend. I couldn't even tell you how many buildings are going up, but we're not talking about buildings that just a little block, an apartment block. We're talking about the waterfront, say in Greenpoint. As you're walking along, there was this incredibly sparse area that was really, it was for ship loading, and it looked terrible for years, but they've reinvigorated that whole area. I'll talk about it when we get back. Basil Chapman sitting in for Tom O'Brien. Dow's down 80, S&P's down $1.75.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Basil Chapman sitting in for Tom O'Brien. I usually do the Tiger Technicians Hour 11 o'clock till noon every weekday and every market day, I should also say. So we're looking at these charts, and I'm showing a down channel right there, a little mini down channel. I call it the Chapman Wave Inside Track because it's something I developed over the many years. And it says that if you break above it, you need to close above it. But if you break under it again, you got to be careful because that becomes extremely strong resistance. And lo and behold, that's exactly what you can see right there. Strong resistance. It means that tomorrow, if there's any rally at all, the Dow has to, rather than making this arch formation and fading again to the third highest peak C minus, which always tells you you're going to go down and test the recent lows. This is going to be very important because it makes the opening price today of 18,034 really important to close above within the next 2 days without taking out, I would say 17,900 should be support. If you go underneath it, that's not going to be very good. Not only that, you made a peak F in the Chapman Wave notation in the 120-minute chart, and that says, watch out. That's usually a very serious time and price move. But look at that pink line there. You see that pink line with 17,922? That's the 200-period exponential moving average, and that should become support. We'll see. Look, it became support right there on that pullback. So we're going to be watching it closely. So there have been some earnings reports, and stocks that had done very well came out with earnings, and they got pummeled. But what's really interesting to me, when I was interviewed by Tom, right at this time, in fact, quite a few weeks ago, I'd said to Tom that from my work, I might be wrong because it's something that's very difficult to gauge. The only thing that could tell me that it's happening is kind of my background experience, just having been in the markets for so long. But my suspicion is that we have been undergoing a mini recession. I call it a mini recession. It's kind of a slowdown. And that slowdown is reflected in many areas, and whether it's the home builders, it just goes right through the panoply of sectors and stocks. There are pockets that suggest to me that when the report, since it's an economic report, it only comes out way later when a bunch of data is put together, and they can look back and see that there have been 2 or 3 quarters of lowered earnings. But wait, most importantly, you've got Harley Davidson comes out today, but it was already, it made a peak D in the daily. No, actually, I should go all the way back. It made a peak F top in the daily way back on the 21st of November at 70.14, broke that 200-period moving average. That became tremendous resistance, still resistance, and kaplop today. It's down 596 at 55.80. And what's really important, that's the daily. The weekly chart went to a peak E, the fifth highest peak in the Chapman Wave at 74.13. That was that same week. No, that was on the second week of the 2nd of May, 2014. And what's happened was the rally that occurred, a very strong rally in October, off the October low, it was propelled higher by that wave of buying that came in on that major low, October the 15th. It went to a peak A and then a B, and that was only at 70.41, 4 points lower than the historic high. And then what happened is it gave it back in a pattern that I call the lowercase h pattern, like that, right there. But it kept holding support, and only today has started to retest the previous low area. Now that low was down at 54 something, 54.22. Today's low is 55.59. And what's really important about this is before it held the 200-period moving average that pinky orange line there, and today it's gone below. So we're going to be watching Harley Davidson very closely, and the monthly chart. I had spoken about this. It was about a year ago. I said I believe we're coming in for a hat trick type top in Harley, and lo and behold, we've not broken above the May of 2014 high of 74.13. There was also an open round number in a monthly chart that is very difficult to do, and that's always a hint to say, hey, be careful, something's happening here. That's unusual. And you've broken in the channels. I'm going to be talking about channels as well. In the Tuesday a week, that is the 28th of April. You can sign up now. Subscribers get free access to Basil's 2 45-minute webinars, Essentials of the Chapman Wave, Tuesday, April the 28th, 5:30 p.m. Eastern Time to 6:15. Basil will be giving a review of Chapman wave notation and wave count, plus familiar chart patterns that repeat over and over throughout the day, week, and even years. He will cover moving averages of importance and their usage, and he will also discuss how they apply to the reading of the charts in his daily newsletter. You can go to the front page, you'll see it right there. That wasn't the he was me, and you'll see it right there. 2 free webinars. And if I click on this, you'll see exactly what it's all about right there. And you can sign up. I'm really looking forward. The 1929 market revisited Tuesday, May the 5th, 5:30 to 6:15. This is going to be a follow-up, and I'm going to be talking about all the matches, where we are, where we've been. And it'll be 3 months, just about 3 months since we last spoke of this. And you know what's very interesting? Look, 3 months, and what have we got? Let me show you something very interesting. In 3 months, INDU, the Dow has gone, so that was in February the 19th. So February, around about there. So right there, the Dow has gone slight high, and now it's just stuck. So the patterns that we were talking about, in a sense, are starting to unfold. I think we're in for a pullback. I'm going to say one of the deeper pullbacks we've had in quite a while, so it'll be more than 6 or 8%. And I'm not sure whether it's started already or if it's just about to begin with maybe earnings come out in the for Amgen and Gilead, and maybe one of them disappoints, maybe one doesn't, one does. But Amgen has a double top all-time high, and in the 172, 173 level, it's trading at 168. Doesn't take much to test that. And Gilead, which is Gilead Sciences, also in the biotech area, has a high of 116.83. It's already made that top. So it might spike above that peak D right there at, that's on the 31st, the week of the 31st of October. Had a low of a round number 108. Always watch those round numbers, and a high of 116.83. So this is going to be very, very interesting. How we come out of this. In other words, I believe that we've got limited upside at this particular point, but the downside is a little bit more open. And that the implication is that, let's just say we've got maybe 2% in the Dow. Maybe if we go higher, but I think we have the 4 to 6% on the downside coming up, and it's going to be pretty soon. Now, here's something else that I consider to be very important. This is the New York Stock Exchange, the very broad New York Stock Exchange. It's trading down 60 and 11,099. I'll explain this particular pattern right here when we get back. Basil Chapman, Tiger Technicians Hour. We'll be right back. Sitting in for Tom O'Brien. My pleasure to be here. Dow's down 90, S&P's down 287.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economy CD. This is a CD that could really deliver, but you only have until May 7th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all the upside. And should they lose, no worries. There's zero downside risk here, as you still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Folks, Basil Chapman sitting in for Tom O'Brien, and of course there's the Tom O'Brien Show. And call in 877-927-6648. Love to hear from you. We've got a couple of emails, a couple of questions in the den, so let's just go through this. The New York Stock Exchange had an island reversal. It negated that yesterday and today because it filled it in. However, what's really important is that the stochastic, the slow stochastic, is turning down. That's number one. The MACD has not crossed negative yet, but it is turning down. So the next, I would say the next 50 points up or down in the New York Stock Exchange is going to be really important. If it's down, you'll probably see that MACD cross negatively. And then what's happening is that the trend line, the dashed trend line that I've drawn in here on the weekly chart, you see, when you keep bumping into these resistance levels until you smash right through that resistance, that becomes a barrier, a formidable barrier. So the New York Stock Exchange is in a G/C, an alternative wave count with the MACD good, stochastic, okay, it's at 82%, yeah, that's good. But what's really important is that it's above the black line, which is the 9-period exponential moving average. So the parameters to watch are very clear. For me, a close under 11,041 would suggest more downside activity. There's a Chapman wave Roman candle right there. I don't have time to talk about it, but that's very important. And the other thing is if we take out today's high, that was an island reversal. If we take out today's high of 11,161, then there's a really good chance you're going to retest the all-time high of 11,203. Very important index here. Monthly chart, nothing wrong with it. Still looks very good, but it's just making nominal new highs. It's gone to look. Peak 11,108 was peak E way back in July of 2014. Since then, it's attacked that area so many times, and yet the highest it's been is only 11,203, just less than 100 points higher in all that time. So it's using up energy, and this is a very important factor. So that was the one question. The next question is Apple. Apple hasn't made a peak D yet in this bounce that is, and I'm calling it a bounce. I suspect, look at that. That Apple chart is not showing any strength whatsoever. It's got limited upside, it's got limited downside. It's just stuck in this range. And this range, this rectangle formation can continue for quite a while, just stuck between, whoops, right there, stuck between about 129-ish and 124-ish, 124 to 122. So it needs to decisively make a decision here that is going to break that high of the 19th of March, power right through the 129.25 level, and get to the 132 area so that it could start to make a cup formation and re-attack that 133.60 all-time high. And that was a peak D. Remember, what did we talk about in the Chapman wave methodology? That the Ds are the ones that you got to be watching for very closely. Let me just try to grab that right there. And if that's the case, what we'll be looking at is, why is that not there? It is. There's your peak D, and you were hugging the 9-period moving average, which is good, but you need to break above it. You just need to break above it. And if that's the case, I'd say that you can retest the highs. To me, I can draw this in, and I think that I feel more comfortable putting it in here, is the rectangle formation in the weekly chart as well. It's just kind of stuck. The evidence seems to be pointing to the slow stochastic and the MACD, telling you that Apple, if Apple takes out the 123 supports, only 4 points lower, that it's going to be making a run for the 120 to the 118 area, and that will start to impact the monthly chart. So far, there's nothing wrong with the monthly chart whatsoever, and I can't say there's anything wrong with the weekly. It's a consolidation, but the level I just gave you would be very important. High-grade copper, question about high-grade copper by Danny. Danny, I'm looking at copper, and I'm suggesting that the whole commodity area, and I'm going to just include for a moment, I just want to show you something. There's been a devaluation, or let's put it this way. I called it maybe more than 10 years ago, the Japanization of our U.S. bond yields. In other words, just like Japan saw their yields go lower and lower and lower until they were practically nothing. So we're looking at the same sort of thing happening now. And that's happening in our U.S. yields. So let me just squeeze this close, and you can see what I'm talking about. If you look at this, there was a cluster formation at 54.08, 5.48% in the 30-year T-bond yield right there. And that was back in June of 2007. That's the white line right there. It continues all the way to there, right there at 25.88 where we are now. 2.5 after being at 5.4. That is amazing. The brown, is the goldy brown color, is the 10-year T-note yield, trading at 19.16, 1.916%. And at 1.341 is the 5-year T-note yield. And you can see they've created a little cluster pattern here as well. So something we got to watch really closely in the yields at some point. If there's an inverted yield curve or a steepening of the yield curve, that's something to be aware of. At this particular point, there's nothing like it. They're still quite far apart, but that's something to look out for. Most importantly, when I'm looking at that, I'm going to go back to copper right now. My point here is that there's been a commoditization of commodities, and I have to put yields into that category as well. But that includes copper, and although copper, historically, you look at it and you say, that is probably economic activity or slowdown or increase. At this particular point, for the past 6 months, let's say, maybe even 7 months, we've been in a trading range with 2.78 as kind of the fulcrum, and you've gone as high as 2.91 and as low as 2.4, and we just stuck in this range. That's the Japanization of bond yields. But most importantly, look at this. On the right here, this is the monthly chart. See, the monthly chart had a beautiful peak, ABCD, pulls back, and then it runs one more big run up to that trend line and reverses. Now that trend line, that channel, now we've got ourselves a potential channel, and we can look at this and we can add another parallel line. And that parallel line will take to the cluster formation there, make it green. Why? Because this has been a base of support. And right now we've gone to that level, gone underneath the 200-period moving average, but we're underneath the 9-period. We're stuck, we're trapped. And that's what I think is happening to copper. It's stuck here until the copper can get to the 3.2 area, instead of being stuck at 2.69, 2.7. I think that copper is telling us there's been some kind of an economic slowdown in construction, etc., around the world. That's just my reading of it. And you can see that in the weekly chart. It ran above the 9-period moving average for the very first time. So far this week, it's hardly been able to hold that level. If copper pulls back underneath 260 in the next 2-3 weeks, that's going to be very poor action, and that's going to suggest weakness in the economy. So answer is, I've got copper stuck in a range. The 120-minute chart right here, way to peak D. You remember peak D? Let's pull that up again. In the Chapman methodology, the peak Ds are very important because at peak D, other things can happen. It can recycle higher if it's within 3 bars and it goes higher. But if it starts to pull back, you've got to be careful, because that's where, doesn't have to happen, but that's likely where the deepest and steepest and longest correction occurs. So that's that. Now we're coming down. We haven't made the full arch formation, or what I like to call the Eiffel Tower straight up, straight down pattern. So we're going to be watching copper real closely. At this particular point, 2.71 is in the copper index is the very strong resistance. And 268 is that better hold, because if it doesn't, you're going to test the recent low of the 15th of April at 2.6685. So that's the copper. Then there was something. Okay, now there are a couple of things. I want you to look at. CMG earnings come out. Now this is going to be really interesting for me, because I wouldn't be surprised. This is peak A, peak B. Is that a peak C? That'll be so interesting. 687.74, 1 penny higher. Yep, 2 pennies higher, and it makes C. So this, let me type this in. You'll see something really interesting. You can use this as sort of a benchmark of what we're looking at. This is CMG, which is Chipotle, Mexican Grill, A, B, C, D. The last peak, D in the daily, saw a very sharp pullback, talking about a stock in the 600-700s, from the 692.43 level down to the 200-period exponential moving average in the daily chart, and a low of 644.06. Let me just type that in so we know what we're talking about. 644.06. 44.06. Now, folks, if you are interested in looking at these chart patterns, trying to understand them, seeing what I do and how I do it, don't forget I have a workshop coming up a week from tonight, 5:30 to 6:15, and that'll be the first of two. The first one is based on the Chapman wave methodology. Second one will be, once again, looking at the matches of 1929 and now. That's not to say we crash, but it says, be careful. I'll be right back. Straight after this break, Dow's down 90 points.
Since 1984, Basil Chapman has been using the Chapman wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit tfnn.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Tom O'Brien.
Now, folks, we're back. So we're looking at CMG. Look at the weekly chart. There's the potential, not one of my favorite patterns, but it's one that I always follow in any case. It is the head and shoulders. See the left side here, left shoulder? There's the head, and there's the right shoulder. This went a little bit too deep for the kind of pattern I usually like to see, but it is signaling that the monthly chart has taken a lot of time to go from the 691-ish area to the most recent high of 727. And where is it now? It's at the 691-ish area. So this 9-period exponential moving average is going to be very, very important. Would not surprise me if CMG starts to see a little bit of a slowdown in their sales. I don't know. This is just the way I'm looking at the chart. And we will know in the shortness of time. And was it the fullness of time? No, it's the shortness of time because it should be after the bell. And it's in a leg D, and that's the reason. Look, peak D at 692 back on the 23rd of March, pulls back to 644, goes peak A, B, C, D, leg D right now. Not a peak. It has to make a lower high bar below 699.03 to make a peak D. We're going to watch this real closely. Now, it's not what happens overnight. It's what happens first thing in the morning. You could sometimes see up 20 or 30 points, but by the morning, these things can be given back or the other way around. So let's see what happens tomorrow morning. We'll use this as a good example. Now, we're about to close out the show. So what I'm going to do is this. Let me just, of course, the next hour, we're going to be looking at the closing prices. But I want to do something right now. I want to go to the VIX index because for those who follow my work know that I spend a lot of time on the VIX index, studying it, trying to analyze it, see where it's going. Well, the VIX at 13.24 is underneath the 13.46 9-period exponential moving average. It is also underneath the 200-period moving average of 15.15. I'm going to make it real simple. If you keep this on your focus, you can use whatever other techniques you have. Just try to add this to your technique. The VIX index, I'm not sure how you get it. Maybe you just go VIX, whatever software you're using. I have to go $VIX.X with TradeStation. Most importantly, you will see that if by Friday afternoon at 4 o'clock, if the VIX index isn't in the 13s or the low 14s, but instead has had a big spike to the upside and is trading above 15.15, let's make it easier. At 15.25, that's all it needs to do. If on Friday it closes above 15.25, that is the start of deterioration in the general market because it's telling me that there is selling pressure. When the VIX goes up, buying pressure for the VIX incurs selling pressure for the general market. Think of it almost like bonds. When the bonds go up, the yields come down. When the yields go up, the bonds come down. Okay, so it's inverse, like Bach and counterpoint. One goes one way, one minute goes the other. Now, what's really important is that the weekly chart has 14.22. So that's the next level of resistance. If it can close above into the 14.25 area, that's above the 9-period moving average. 1660, that's a long way to go. You'd have to see some real deep selling, something has to happen, maybe overseas, whatever it is. Some event that the market perceives as bad news. In other words, what we need to see at this point is a rising volatility index accompanied by bad news to sustain a negative environment for the market. Anything else says, ho-hum, I'm just going to stay in this little wobbly period of up and down within a channel, sideways kind of a channel, and that's what you're going to be looking at. And certainly at this particular point, stocks are still the only thing that are giving, well, real estate, I wanted to talk about Brooklyn. Maybe in the next segment, I'll be able to talk a little bit about real estate in Brooklyn. But I also look at the IYR, the REITs index, etc., and we'll look at the IYT, we'll look at the others. I want to see where the market closes. So that's for those of you who aren't able to come in for the next hour. Watch the VIX index. Staying in the 13s, low 14s is okay, but actually a close on Friday above. I'm going to go for the weekly chart above the 14.25 level. Would say watch out, because that 15.15 level for the daily is going to be next resistance, and then 16.60. Those are the levels that I'm looking at in the volatility index. The moment the VIX daily starts to make higher highs and higher lows, you will see the general market start to make lower lows and lower highs. And until that happens, this is just going to be a market that favors certain stocks. Remember, if you're looking at different stocks for my subscribers, I said we're following FireEye today. It gapped up. It wouldn't even have a chance. Even if I wanted to get it, wouldn't have, because it gapped. It looks like it might want to make a D in the weekly chart. It's at peak C already. It needs just to go from the high of today, which was 44.50, trading now at 43.42, and it needs to push 1 penny above 46.44, and that starts leg D. But there are not that many stocks that are able to do that these days. And this is just a retracement. It could actually fail at some point. Why? Because its major high was back at 83 open on the monthly chart, hit 97.35, and then it plunged down to 24.81. So this is just a retracement at this particular time. Interesting article in the Boston Globe today. Closing some of these 3D stores is one that was on Newbury Street. I always wondered about it. Yeah, people kind of walked in, a few people here and there. I said to myself, they must be paying absolute top dollar for a prime place, and they're hardly selling anything. They got these young people just doodling on their own, not really. And all of a sudden, I see they're closing 3 stores. I can understand, but what a pity! What a wonderful 3D. Being able to take patterns and produce constructions from them. It's an incredible feat. I don't know. They just did the wrong thing, that's for sure. But in fact, what they should have done was they should have used that and had it. The whole advertising, the whole aura that you go into, it reminds me of the Museum of Science here in Boston. I always used to complain that you had to go to the exhibitions, but from the moment you put your foot, the first foot, into the museum, everything should start happening. The air that you're displacing, the sound of the footsteps, the actual weight of the footsteps. I don't have to tell you your weight, but just the weight of everything should be science. They're just missing out on so much there. Anyway, back to our story. So let's just look at this on the S&P. Maybe some of you look at the SPY because it's a little easier. You don't look at the indexes. Well, the SPY made their peak D. It went right to 211.04, tried to break it today. Instead, it went back into that. Look how many charts have this downtrend line. Well, we're about to get a close, and that's going to be really important. I'll be right back after this break. Basil Chapman sitting in for Tom O'Brien. And don't forget, a week from tonight, I've got a webinar coming up, 1 of 2. Check the front page of TFNN, see what it's all about. Basil Chapman signing off for this segment. I'll be right back.
The following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Marty in Worcester, Mass. Hey, Marty, what's going on?
Hi, Mr. O'Brien. Got a quick little thing here.
Yeah?
It's called patience and perseverance.
Okay.
Patience. I heard a goddess yelling, the magic silent word, and methinks I must be smelling pokey money round the world. Perseverance. When markets roil like stormy seas, good traders seek safe port. In financial times like these, you need Tom O'Brien's gold report.
You are too much, Marty, man. That is so cool. Well, listen, man, I really appreciate that.
Now, Tom O'Brien.
Hi, folks. Basil, Chapman, Tiger Technicians. Oops, it wasn't a Tiger. It was Tom O'Brien show. It's just a habit because every day I do the Tiger Technicians hour, 11 o'clock till noon. Sorry. It's my pleasure to be right here. Tom O'Brien show. And Tom's away, and it's my pleasure to be here. And we're looking at a very interesting market. Dow's down 85 at 17,949. The S&P's down 3 at 2,097. The comp index is up 1950 at 5,014. You've got gold at this particular point. Gold is up $7 at 1,200. You got silver up a little bit at 15.96. Bonds are down 11.30 seconds at 163 and 14.30 seconds. Dollar is up 0.03 at 97.97. And we've got copper. Where was copper? Copper is down at 2.70. We've also got earnings. We've got CMG earnings, and we were doing that just before the end of the last hour when I was on. And I was talking about CMG, and I said we finally got leg D. What does that mean? Well, in the Chapman wave methodology, there's a very simple technique I have. Let me just pull this across here. It says, I've even written it in here. It says, from the lowest, most identifiable low bar, merely count each successively higher peak. If you're going from a buy signal to a buy mode because the pattern is very strong, you should be able to go to a peak A, a second peak, which I call peak B, as a third peak, peak C, and at peak D, other things can happen. It doesn't mean to say you should get the sharpest decline, but that's very often where you could get the sharpest decline or a recycle higher. Well, lo and behold, I did this analysis just a short while ago. I said Chipotle CMG had made a peak D on the 23rd of March at 692.43. It pulled back to where? To the 200-period moving average, that dotted line that I'm showing right there. The left side is the daily chart whenever I show my charts. The middle one is the weekly, and the right one is the monthly. And I've just included here the 120-minute chart. So you've got 4 time frames. And what we're looking at is it pulls back to 644.06, turns around, the stochastic and the MACD start to rally strongly, and it goes peak A, pulls back, doesn't break the low, and then boom, some news event takes it higher, and it gaps higher, and it goes to a leg B, then a peak B, a leg C and a peak C, all underneath the previous high, and then boom, today it spikes over that previous high and goes to what? Leg D. And what I was discussing moments ago was that everything about this chart says that you got to be somewhat careful because it's a pattern. It's not one of my favorite patterns, but it's a pattern that I respect nevertheless. It is a head and shoulders pattern. And on the left, you've got the left side shoulder. In the middle, you've got the head at a peak D in the weekly chart. So now we've got 1D in the daily, the last leg up. You've got a peak D in the weekly, and you've got the right shoulder over there. And this pattern says that if you were to break down under the 9-period moving average, you've got to be real careful because it could continue much lower. And if it was to bounce up, then you would get maybe a cup formation trying to retest the previous high. But I said, I'm a little nervous about, well, didn't say I was nervous. I said that I'm a little cautious in the outlook here because it looks to me, based on the monthly chart, the way the pattern's forming here, that there's very limited upside, could be down. Well, lo and behold, earnings come out. It's down 28, down 4% at 659. 659 takes it right to the gap. Isn't that funny how that works? You know, Tom always talks about how gaps get filled. Look how that gap is going to probably be filled tomorrow morning. We'll see. They've still got to, there's still the conference going, you know, other things happen. So by 9:35 tomorrow morning, we'll know what's going on. Everything else is just noise. It's the way it prints. It's the response to the news that's most important. And the monthly chart says that there could be a hat trick top if at some point in the next 3 weeks, CMG, Chipotle Mexican Grill, takes out 600 as key support. If it does that, you've got something that's going to be time and price to the downside. So I'd be watching this real closely. All right. So a couple of things here. You see these patterns that we're looking at? The way they're letters, the way you can talk about a double top at 727.79 the week of the 9th of January, and then all of a sudden it retests and it goes to 726.98. Just, what is that, a point, less than a point higher, lower that is. Those are double tops. Those are very important in my work. So what we're looking at here is the chance that Chipotle might be, it could come back by later tonight, or it could come back tomorrow, but it's saying there's a certain vulnerability here in the chart formation, and it's how it prints. That doji candle right there is going to be big, because if it closes under the low of 682.63 in the next 2 days or so, without making a new high, it says be careful. Chipotle has limited upside at this point, but probably going to start making lower highs and lower lows. So you always want to trade. If, for instance, if you had an option and it was down 34 at some point just a little while ago, you can't do anything after the market closes. That's the lousy thing about options. They are fantastic when you can use them in a different way, but when you are stuck and out of the blue, you've got a fantastic paper gain. By tomorrow morning, Chipotle could be doing anything. You just don't know. It's the response. It's the outlook. It's a whole bunch of things that are going to be going on. But the pattern itself says it's getting very choppy. Something's going on. I would not be surprised if there is a bit of a slowdown in sales. Okay, now let's look at something else. We've got Amgen. So Amgen comes down, part of the IBB, part of the NASDAQ biotech sector. It's at 172.65, up 666. 172.36 was the last high. So it's printing right now, not at an all-time high. The all-time high was 173.14. But that, in fact, is the same situation. What you want is to find out what they're going to discuss, what the outlook is, what they have on the drawing boards, a whole bunch of things. It's the price action tomorrow that we'll be looking at to see, is Amgen telling us that, in fact, this is the final hurrah, and it's spiking to an all-time high with really good news, and from now on, the news is not going to be quite so good, or is it just merely business as usual? Biotechs are doing amazing, and this is just a continuation of that pattern. You'll only know tomorrow at 9:35 when the market opens, and we'll see where Amgen is trading. Could be up 16, could be down 10. You just have no idea as to what is going to go on. Pattern-wise, there should be a test of that doji candle with a long-legged doji with a close of 170.10. That's what you would have expected going to a possible leg D, but it can fail under the previous high. It's an unusual G, but we're going to be watching this closely. This pattern of the cup formation says that if you break out above it, there's a really good chance you're going to come back and test the lip, between the lip and the last moving average of importance. In this case, that is right here at 162, and that should happen over a period of 3 to 4 weeks. I don't know if it's going to happen. I'm just saying that this particular pattern with the cup formation very often produces yet another cup formation. All right, we'll watch this, and we'll continue here. So now there are a couple of things I was asked about. But before I do anything else, I want to discuss something, and I'll come back to it a little later on. The VIX index. The VIX index is trading at 13.25 at the close today. It got repelled by the 9-period moving average, that black line of 13.46. These are the numbers I'm watching. If on Friday, at 4 o'clock this Friday, if the VIX index is trading anywhere in the high 13s, we'll be watching 1422, because a close above that 1422 level will be the first time the volatility index has closed above the 9-period exponential moving average since it did that for 1 week back in January the 30th of this year. It went to 22.18, couldn't hold it. The next week it closed under it, and after that, every single week it closed underneath it. It closed it right on it 1 week. That was the week of the 13th of March, but it was just on it and wasn't really above it. And the MACD is not very good, but it's starting to flatten out. And if you look at the histogram, now I'm going to be talking about some of these things. I'm going to be doing two consecutive weeks of workshops. Let me show you right here. This is the my opening call. You'll get my opening call as it's only open to subscribers. But if you sign up for a free trial for my opening call, you'll be able to attend that webinar. The last one I had back on April 19th was on the 1929 market. The match between now and then. Doesn't mean to say we have to crash like a depression or anything, but it says be careful. And we're going to be looking at the essentials of the Chapman wave methodology. I'll talk a little more when we get back. Basil Chapman sitting in for Tom O'Brien. This is the Tom O'Brien Show. My pleasure to be here. I'll be right back.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe future economy CD. This is a CD that could really deliver, but you only have until May 7th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all the upside. And should they lose, no worries. There's zero downside risk here, as you still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. Basil Chapman, yes, sitting in for Tom O'Brien. It is the Tom O'Brien Show. The Dow was down 85 at 17,949. S&P's down 3 at 2,097. Comp index was up 19.50 at 5,040. Now it's my pleasure to introduce Andy Hecht. And Andy, how are you?
Hey, Basil. Good to speak to you. How you doing today?
It's really good to speak with you. First, before we do anything else, tell us about your newsletter and your service and your daily show, your Tuesday, Thursday show, please.
Okay, my newsletter is the Technomental Commodity Report. It comes out each and every Thursday morning, and I go through all the commodities markets, all the futures markets, and I give trade recommendations using not futures but ETFs, ETNs, commodity-related stocks, and options. And my show is on each Tuesday and Thursday from 5 to 6 p.m. Eastern Time, and it's called the Commodities Hour, and we go through commodities and how they affect all of our lives and all of the things we trade.
And before you go any further, I have to add that in terms of the fundamentals, in terms of the knowledge and the experience that you have, you are just a wealth of information, and we all appreciate what you tell us, because it's not just looking at the one particular contract. You have to look at the further out. You've got contangos, you've got all sorts of things. I'm going to ask you a question. Do you have the copper chart up right now?
I do. I saw it in the den, the question, and I wanted to talk a little bit about copper here, because copper is really interesting these days, Basil. You know, leaving the technicals aside, and from what I look at on the chart, since 2011, this is a market that's been making lower highs and lower lows.
Yes.
And copper is very much the barometer for growth around the globe, particularly in China. And I think the fact that copper did a couple of things this week. First of all, it put in a key reversal on the daily chart yesterday. It made a higher high and closed below the previous day's low, which is a bearish formation, in light of China putting some more stimulus into the market. So for a while, I've been very bearish on copper, and I continue to be so. Below 272, it doesn't look good to me here. I think we're going to go back, retest those lows at $2.40, and my target all year has been about $2 a pound on copper. I think there's a lot of copper production coming out. A lot of the producers now, like they've done in iron ore, are willing to sell more of their raw material production at lower prices in order to increase market share for the future. We've seen this in iron ore. We're seeing it in crude oil with the Saudis, in the period through, after the OPEC meeting in November. And copper is just like these. It's an industrial commodity, and it's telling us that all is not great with the economic landscape across the globe.
So it's very the points that you're making are actually very salient, in the sense that when I'm looking at the commodities, I'm looking at just the price. But it takes quite a while to be able to discern that the price is not going much higher, because not just of a slowdown that seems to be occurring throughout the world, but in fact, it has to do with a glut in that particular commodity.
Well, yes, and there's something else that's going on in copper that doesn't go on in other commodities. For the last couple of years, the Chinese have been buying a lot of copper and putting it in warehouse. And what they've been doing is that some of the Chinese firms have been using copper as collateral to borrow money borrow cheaper money. So in other words, since U.S. interest rates have been very low, they've been able to go and take U.S. dollar loans, pledge the copper as collateral, and then keep these stockpiles there for later on when the country needs it. However, if the copper price starts dropping, the value of that collateral decreases. And if it decreases below the loan value, you'll see liquidation. So that could be something, and I wrote an article about that recently on Seeking Alpha, I think last week. That could be something that actually brings more selling to the market at lower prices. And that's because of a big cash and carry trade in copper that's been going on, Basil, for the last 3-4 years.
It's so interesting that you mentioned that. It reminded me that in the late 1920s, France was hoarding gold.
Mm-hmm.
And in fact, there was an obligation to Britain, and America had an obligation to Britain as well. And there was this whole collateral. There was this, when the market came down in 1929, into 29, into the Great Depression, gold started to soar. But the most important thing was, there was other countries were very upset with France for doing that. And it created a whole bunch of problems later on. So,
right. I mean, it's interesting. France has always been in the kind of France is a small country, and they're a big gold holder. But they've always, you go back to the Great Depression, they were involved. They were also involved in the reason that Nixon closed the gold window.
Oh, that's right. I completely forgot about that.
Because didn't the French come in the 70s and say, hey, we want our debt paid in gold? And President Nixon at that time said, hey, we're not doing that. They closed the window, and it changed everything, really.
It did, right. In fact, when I came to the United States, gold was $35 an ounce.
Oh, yeah. When I was a child, it was too. Between 32 and 35, and it was fixed there. Only in the late 70s, after Nixon closed the gold window, did it rally up to about $170 an ounce. And, you know, the rest is history.
Right. So what you're looking at this particular, I was talking about this earlier, both in my show earlier at 11 o'clock this morning, and then again when I did Tom's show this previous hour, that there's basically been a commoditization of commodities, and even yields are being commoditized.
Yes.
What is the implication there?
Well, it means, look, there's more money today. Look, with these low interest rates, you know, interest rates here are very low. But if you look in Europe, I mean, in Denmark, in Switzerland, they're negative.
They're giving away money.
Exactly. What they're trying to do is spur people to spend more consumer dollars. But basically, low interest rates make other assets more interesting to trade. When interest rates start going up, you're going to see a lot of volatility. The stock market's going to have a really hard time, and commodities are going to have a really hard time. But what you're seeing now is that people are looking for yield. They're looking for capital appreciation all over the place. So, you know, these sectors are attracting interest now. But right now, I think that with the perception that interest rates will eventually start to rise in the States, we're starting to see some cracks in the earth. We're starting to see some cracks in the equity market, which doesn't look that healthy to me. I don't know how it looks to you on a technical
Exactly.
day.
We were talking about that just a while ago. It's very selective. Fewer and fewer stocks are leading the rallies. When I look at the Dow was way weaker than the S&P. S&P was way weaker than the NASDAQ. And what we're looking at is the industrial type sector. They are suffering. They're suffering both because of the dollar. And as I say, I don't know if you heard it, but I believe that we're in a little mini recession right now. That's the way I'm looking at the way I'm reading certain sectors in the market, certain of the engineering stocks, the uniform, the overall companies are slowing down. Something's happening here.
I agree. But you know what? It's all relative, Basil, because relative to Europe, relative to China, we're a lot better. Even if we're in a mini recession, they're in a maxi recession.
Right. Tell us again how folks can get your newsletter, please, Andy, as we go
Just
out.
go to the homepage, the Technomental newsletter.
Fabulous. And it's Tuesday, so your show's coming up at 5 o'clock, right?
I'm following you tonight.
Great. Thank you very much, Andy.
See you soon, Basil. Thanks.
I'll be right back, folks. Dow's down 85. Be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the TFNN.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. Basil Chapman sitting for Tom O'Brien. So Tom O'Brien show. Let me just run the numbers. Dow's down 85 at 17,949. S&P was down 3 at 2,097. Comp index, that's the very broad NASDAQ comp index, up 19 at 5,014. The VIX index was down 5 cents at 13.25. I'm going to talk about that as we wrap up the show today. Very important indicator for me. And we've got some very interesting things. If I look at ISRG, earnings came out now. One of the techniques that I discuss and what I'll be talking about for this web, I've got two 45-minute webinars coming up. The first one is a week from tonight at 5:30 to 6:15 Eastern Time. The following one is a week later. And most importantly about these webinars is the first one is going to be dealing with, let me see if I can get it right here, TFNN. Go to the front page. So 2 free webinars, and I click on it, and well, there it is. April the 28th, Tuesday at 5:30. The essentials of the Chapman wave. I'll be going through the techniques of these are basically the essentials of the Chapman wave. These are the core techniques that can really help in assessing and dissecting the different chart patterns. Remember, chart patterns, 1 minute chart, monthly chart, these are fractals of human nature. They repeat over and over. The same kind of patterns repeat. It's either an arch or an inverted V, or a cup or a V-shaped pattern, or a straight line. It's basically 3 patterns that you're looking at. Now, here's the other thing. When I'm looking at, there you can see the picture. When you look at this, that's the April 28th webinar. And it's open to subscribers. And if you aren't a subscriber, there's a way of getting it. You'll be able to get it for free. May the 5th, the market 1929 revisited. Now, what's really important about this is, you remember I was speaking to Andy just a moment ago. He was talking about gold. And what's happening right now with copper, and we started talking about gold, and I mentioned about 1929, what happened with France and gold. We're going to be discussing those things. What are the relationships? What things repeat over and over in human history? Doesn't mean to say that we're going in for a massive, some kind of a depression. It does say that we're going through real estate sectors in Brooklyn. There must be 5 blocks, different blocks, huge blocks, entire blocks of buildings that have been bought and are in the process of being raised or being built on. And those are 800 to 1,100 apartments right there. And they're not building 3-bedroom, they're building 1 and 2 bedrooms. I don't know what's going to happen to folks who need 3 bedrooms. Anyway, and they're all the way along. And they've got this beautiful design that actually goes way back to the 1969-70 period, where Mayor Lindsay was talking about refreshing all those different little ports and those little venues where the boats used to dock, and they had warehouses. So those are being changed. There are a couple that are still there, but basically a lot's been sold. They're building a beautiful garden path. Some of it's already done. I hope they have enough money to keep doing it, because it should be fabulous. But it's a rejuvenation of an entire sector, an entire city. Most importantly, the overbuilding is really troubling. There are 5,000 new apartments, imagine, over the next few years. It could be even sooner, because they're really building them quickly. That is going to create a problem. And we saw that the whole Northeast held very well during the crash, real estate crash of 2007, right around the country. But in fact, what happened was, because we held so well, we came back quicker. And there are so few houses for sale, I'm told by real estate agents, that they are vying with one another. I get letters almost every day. Don't you want to sell your house? Well, you think we have perfect buyers for you. We have everything lined up. All you have to say yes. Yeah, sure. Anyway, something's going to happen with this real estate. It just can't keep going on. Anyway, I talk about skyscrapers and the match between the skyscraper phenomenon of the 1920s with the Empire State Building. The papers were signed in August of 1929. The top was in the market was at 386 the Labor Day weekend. 1932, the Dow was at 40. And then there was a spectacular rally right through the Depression with all the bad news of the New York Times every single day talking about the Depression. And it was a real depression. But the market went up threefold. So it happens. All right. So I'm going to be talking about the match that's going on right now and what we've got to be careful of. And that I do expect that we will get some pretty darn sharp correction before we go to even higher highs. That's the way I'm looking at it. That's the second webinar. So 2 45-minute webinars. It's going to be fascinating. And this is just a perfect time. I spoke about it earlier on that the Dow has taken since early February, it's in the same trading band between the 17,600 area and the 18,100 area. Look at that. That's been a rotating correction, a rolling correction where some sectors have come down. Utilities came smashing to the downside. You've got the biotechs going to perhaps all-time highs with the news out now with Amgen. So we'll see what happens over the coming weeks. But I'm really looking forward to these two webinars for subscribers. Look, ISRG. This is intuitive surgical. Remember the trend line I drew earlier, and you saw it in all my charts, in the daily charts, that declining trend line. It's also in the weekly charts. Well, there's one here in the monthly chart. Patterns repeat. It can't get out of its own way. It just keeps trying to rally, and it's up near the highs, but it can't break out. Intuitive surgical, that is the Da Vinci code, the Da Vinci technique for surgery. So look at this. It's trading now down 27. Earnings just came out, round number 525 at this particular point. And it made a peak. I'm pretty sure there's going to be a peak E as there's a failure in the technicals. And if 522 is taken out on any weekly close, you've got yourself a failure pattern. So you're going to have to be real careful. Let's go back to CMGC where it's trading right now. It's probably coming back a little bit. Yeah, it's a little bit. So it's down 21. We'll be watching this real closely. Leg D. Remember what I said in the Chapman methodology? Let's do that one more time for new viewers to Tiger TV. In the Chapman methodology, you try to identify the lowest, most obvious low bar. And from there, you merely want to count each successively higher peak. Peak A, 1 penny above it, even if it's trading at 17,333.00. If it goes to 0.01, it starts a new leg above that A. So that's peak A, B, C, D is where you want to be careful because other things can happen. You can get the Chapman wave instant restart, a whole bunch of things. So let's just run our numbers here. You've got the IWM, which is the Russell 2000. It went to a G/C. I don't want to make too much of a fuss. Just look at the patterns. This is a pattern that we look at very often in the Chapman wave methodology for subscribers. The price runs up, and then there's a very sharp pullback, especially if there's one really ugly candle. What happens often is if the price holds, especially if there's a gap below, but if the price holds, what you want to see is that within it you get a Chapman wave buy mode in a shorter time frame. In this case, it would be the 120-minute chart, which takes you to at least a D. And it's exactly what happened. It went to peak F in the daily in the 120-minute chart. IWM pulls back to the 200-period moving average. Look how important that line is. You don't need it until you need it. And look, it's like a ricochet, pow, and takes off peak A, B, C, D, pulls back and goes another A, B, C, D, pulls back, does an E, an F, and a G, and it pulls back. Could have been a C, but it might be a C minus, but it's really a G because of the technicals here. And look what happened. Technicals fail, comes all the way back. It's going to be real tough. The IWM, trading at 125.52, needs very much to clear 126.30 to 126.30. Why? Because if it does that, it can tackle the 127.13 level to go 1 penny higher and make it clear that it's a D. And then they will extend. If it's this week, it extends that leg. But I've got this as a potential leg or a peak F. So I'm going to be watching the IWM very closely. No problem. The weekly chart, the monthly chart price is fabulous. It's going towards the up channel resistance. But look, the stochastic and the MACD are not really confirming this move. So I believe that we are real close to some kind of a pretty decent pullback in the general markets. The fact that you've got this diversion between the weak Dow all of a sudden, the S&P a little bit better, The IWM not quite making a new all-time high, kind of stalling here. Yet the QQQ, which was a weak link, is rallying very strongly today. And yet, look, there again is that same declining trend line. Look how important. I'll make it dash so it makes it even look there. Doesn't that look important? Let's make it red. Now I'm going to make it green, because if it closes above it, that's very positive. But it hasn't been able to. And underneath it, I'm going to do a Chapman wave inside track. Look right there. And now look what we've got. All of a sudden, you've got your parameters nice and clear. You're right in it. We'll see what happens tomorrow. It's going to be a very interesting day. Basil Chapman sitting in for Tom O'Brien, the Tom O'Brien Show. I'll be right back. Dow's down 85 and the S&P's down 3. We'll be right back, and I'll give you a wrap-up as soon as we get back in.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Each and every time that the dollar ticks higher, S&P wants higher price. Each and every time that the dollar's ticking lower, guess what? S&P wants lower price. Dollar, the metals, and the S&P are going tick for tick.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. Join Andy Hecht as he shows you how to make money in commodities. The Commodities Hour, next on TFNN.
Tom O'Brien.
Hi, folks. Basil Chapman sitting for Tom O'Brien. This final segment here before you go to Andy Hecht. Don't forget, you heard the interview. Andy's just a font of information about commodities. Just a fabulous analysis he does. So we're looking at Great Britain. This is the Dow Jones UK Stock Index. It mimics exactly the price, but the pattern, but it doesn't have the same price. It's made a peak D. Remember we spoke about those peak Ds? Peak D in the daily at on the 16th, so whatever the high is that you have on the 16th, it needs to take that out and take it out decisively to really accelerate higher. But I've got a D, leg D in the weekly chart. No new high above last week's high would be a negative. And I've got a D in the monthly. And remember we were talking about in the weekly charts of the S&P that peak C1, C2, maybe a C3. Look, there it is. And look how sharp it fell right there from September of 2014 into October's low. That was a huge plummet. So we're going to be watching this really closely. And what I'm looking at here is that there's also a price time match. Look, the time match, no, just a time match between the high that was made back in 2007 in June, the low that was made in March of 2009, and then right back up to the high that was made in May of 2011. Using that, we've got exactly the same number of months, exactly to this month of April, in in the time match from the left side to the right side. So we'll see it's going to be a very important month, April, for the UK index. And I can go through others, but I'd rather do this at the moment because of the limited time. Let me do this. I have a webinar coming up, 2 webinars, 45-minute webinars. They're going to be discussing the techniques that you're looking at right now, peak Ds, etc., using the MACD, the slow stochastic, looking at time lapses and price matches, the arch, the cup formation. Those are going to be very important, right? You go to the front page of TFNN if you're interested. If you saw my work and you thought, hey, that's very interesting. So it's right here. It's April the 28th, Essentials of the Chapman Wave. Free webinar to subscribers, and on May the 5th, the market 1929 market revisited. So that would be very important. Now, let's go through what I'm looking at here. I believe that there are a number of factors. If you look at the IBB, how the IBB responds to the latest news, it's up at 368 right now. The high was, all-time high is 374.97. You've seen how many cup formations have double topped that are in the charts that I've shown you today. Let's see what happens if it gets even close to the 370s in the next 2 days and how it pulls back. Any pullback that starts to give back with the MACD in the weekly chart going negative and the stochastic staying underneath 80% would say, hey, be careful. We could, in fact, see the first pretty decent pullback since October in the IBB, the biotech iShares from the NASDAQ ETF. Okay, now here's another thing. I'm going to go back to the VIX index because I think it's imperative to follow it. Why? Because for me, it's simply buying pressure and selling pressure. In this range here, it's giving support. The buying pressure has not made new all-time highs in the Dow and the S&P. So all it's doing is it's giving support, and you've got enough stocks that are rallying to be able to give some of these indices enough impetus to push higher. but it's fewer and fewer stocks as I'm looking at it. That's what I'm seeing. So this is very select, and you've got to be careful when it's a select rally, especially when you're getting divergences between the indices themselves. So if by Friday the VIX isn't down here in the very low teens, the 13 area, but instead is in the 12s, that's still going to give support to the market. The market will manage somehow or other to push higher. Most importantly, if all of a sudden you see this candle that looked very ugly for a moment on the 17th, just a few days ago, if that gets revisited and the VIX gets anywhere close to 14.47 based on this candle right here, be careful. There's a good chance that you're going to go higher. And then that 1515 level on the 200-period exponential moving average would be a major, major upside, not a breakout, but an upside stance that's being taken to try to make higher highs, and you'll see higher lows. That's going to be very important. Now, you've got to get to sustain a down move in the general market. Just like in a bull market, speed is your friend. In a bear market, speed is your friend to the downside. That would imply that you've got to get bad news that is perceived negatively in the market, number one, and you've got to have the VIX index rallying, or you're not going to sustain any selling pressure. You'll just constantly rotate because there is such a limited resource now of capital gains because of bonds, because of commodities pulling back. I didn't want to take time now. Andy will do it. I wanted to go through some of the commodities other than gold, which I looked at earlier, which is just stuck in a trading range, and high-grade copper. There are many others, but let's leave that for now. I'll mention only that crude oil monthly chart has given that almost a one-to-one to the downside, and now it's giving a nice bounce to the upside, but you've got to be real careful because of that glut that we were talking about earlier that seems to be in place. So now let's just say that by Friday at 4 o'clock, if the volatility index is rallying and it's getting close to the high 14s to the low 15 area, that's going to suggest the following week could be a pretty mixed market with the bias to the downside. But if, in fact, we stay here, you'll see that there's going to be a rotation into the best sectors. Hey, the IBB might even break out and become a leader again. I just didn't think that was possible. But, hey, it's been an incredible benefit to fund managers. Every time it's come down, if they've bought it, they've made money, even within an hour of buying it. Let's see if they can. I think that's run its course. I think the IBB is really close to turning down. I think the XLV, the healthcare sector, showing signs here of tiredness, even if it just goes sideways. I think it's the XLVs, the S&P Select Healthcare Spider Fund, I think is problematic. And the IYT could bounce here, but this is not a good sign that the transports have been fading. So the IYT at 157.77 needs to break quickly into the 160s, because if it goes back down under 155, not good action at all. So let me leave you with that. And don't forget, my service is the opening call. It's a very comprehensive daily report that comes out starting very early, 6:37 in the morning. I start sending out this chart here, the Dow chart. I've already started writing some of my comments for tomorrow. And not only that, I then do the overview. You remember I showed that earlier on. Very comprehensive look. I discuss what's working, FEY, Amazon, Facebook, Cyber. These are stocks that are doing well. Even Google and Microsoft had a bounce. But I speak about the IYT and the IYR. The REITs have been very weak. And I discuss all these things. And I say, look right here, these two inverted Vs are very important. And I say, if under 13, the market will rally on the VIX. Over 13.70, it should pull back. So there are a lot of things that you can get. Thanks for being here. Thanks for allowing me time to sit in. It's my pleasure. Listen to my show and come join me. Give a call at 877-927-6664. 8 tomorrow to the Tiger Technicians Hour, 11 o'clock. Have a great evening. Thanks for being here. Stay tuned for Andy Hecht. Great show coming up.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com.
This is TFNN.